Landlords right now are panicking. Let's just talk vacancies for a second. The national vacancy rate is 8, but the luxury vacancy rate is 11 and climbing. That's a 3% differential. If you're one of the luxury apartment complex owners, you are freaking out. You had companies like BlackRock and Blackstone going out there and buying up all the single family homes, and they still are doing that. So pretty soon we're going to be renting from who? Not mom and pop. We're going to be renting from the institutions. What's going on, everybody? My name's Chris Naugle, and welcome back to the Money School podcast, where we teach people how to take back control of their money. And we do that by teaching them how to be the bank. But in today's episode, we're not talking about that so much. We're going to be talking about the real housing crisis. Yeah, the real one. And I'm going to dissect it and explain it because it's not what you think. So get ready. This is going to be a surprise for many of you. Now, it is no surprise that for the last 5, even maybe 10 years, all we've been hearing about is the housing shortage. And make no two ways about it, there is absolutely a housing shortage. I've done lots of research. As of today, the housing shortage is somewhere around 1.5 million to 7 million units. I know that's a big spread, but that's just what the data came in at. So let's just split it down the middle. Let's say we got a real housing shortage of about 3 million houses, okay, or 3 million places for people to live. So during the last couple of years, especially after the pandemic, developers got on board with this. We were all sold this bill of goods: supply versus demand. There was so much demand. I mean, come on, 1.5 to 7 million houses are short. We need housing for people. People need a place to live. Job growths are going up. I mean, the economy was doing good. It's not so much doing good today, but it's all part of the cycle. We're not going to talk about the economic cycles today, but we are going to talk about the housing cycle and where developers have got it wrong. Now, let me take a step back. How many of you drive around your town and you see new development of apartment complexes? I see them everywhere. I'm in Buffalo, and it's kind of interesting. Let's talk a little bit about Buffalo, New York. You've probably never heard of Buffalo, New York making the headlines except for the Buffalo Bills and maybe Niagara Falls, right? It's not exactly the mecca for people or the place where people want to move and live. It's not like we have beautiful weather. We have blizzards in the winter. We do have beautiful green, lots of trees, lakes, fresh water, but for the longest time, Buffalo was kind of just the armpit. It was the Rust Belt city of the East, but not now. You see, Buffalo has secured the title as the hottest housing market, and this is the second consecutive year that Buffalo is called the hottest housing market. Now, listen, I flipped a lot of houses here in Buffalo. I owned up to 91 units here in Buffalo. I'm going to sit back and I'm just going to tell y'all, this ain't the hottest real estate market. I don't care what they're saying, but they're going off of this data. There's a high demand for housing, okay? There's low supply of housing. I mean, those sound good, right? High demand, low supply. Yeah, you're ringing right. And we have strong jobs growth. A lot of companies moving here to Buffalo to operate because, well, tax incentives, lots of incentives, and we got fresh water. Let's be real. But see, where the developers have all gotten it wrong, and when you drive around your town and you see all these apartment buildings being built, let me ask you one question. What do they look like? Do they look like luxury apartment complexes? You see, I got one right over here. I got another one that just is getting built. It might even be done now right down there. I've got housing everywhere, and I'm just in little old Clarence, New York, a suburb of Buffalo. You go downtown Buffalo, there is buildings being built everywhere. But when I look at the buildings, I see something. I see something that tells me that all my data we're going to cover today is correct, and the developers got it wrong. You see, although there is a housing shortage and a fairly big one, we never seemed to go back, or the developers never seem to go back and really run the numbers of what kind of housing are we short on? Well, I guess post-pandemic, this wouldn't have been a problem, but today, this is a really big problem. You see, we don't have so much a luxury housing shortage. we have an affordable housing shortage. And here's the numbers. You see, as of right now, according to this data, only 6,700 affordable apartments are under construction. Let that sink in. 6,700 units of affordable apartments, which the average rent of an affordable apartment by definition is $1,332 a month. That's affordable housing or lower. Okay. Anything above that would start getting into the difference. And I'll show you that. I got a chart 1 and 2 star, 3 star, 4 and 5 stars. When I show you this chart in a moment, you're going to see where the problem is and where they got it wrong and where the real housing crisis is beginning. And I'm going to unravel all this in this podcast. But how many of you, when you drive around, see affordable housing being built? And you can tell. It's just by the way that they look when they start putting the facade on the outside. You can tell, is this a luxury apartment building, kind of a mid-grade apartment building, or is this affordable housing? We all have seen affordable housing. It's not super pretty. It's not super fancy. It's affordable. And that is exactly what the data is saying we need. But you see, the developers are not building affordable housing. They are building luxury apartment complexes. You see, as of right now, the demand and supply is flipped. The demand is for affordable housing and growing by the day as the economy weakens. The demand is not for luxury 4 and 5 star apartment complexes. However, as of the data I just researched, there are 500,000 luxury apartments under construction. That doesn't account for how many were already built. This is just how many are under construction right now. 500,000, 500,000 luxury apartment complexes that the people who need housing probably can't afford without some type of subsidy, which I'm going to cover in a second. But that's the problem. But now let's go one step further. For those of you that live in the Sun Belts, let's talk about Florida and Texas. Now, I travel to these two places, these two states quite often, and I see it firsthand. So any of you that are listening here, if you live in Florida or Texas, you can concur. The apartments they're building, man, they are freaking nice, especially the ones downtown Dallas, downtown Houston, downtown Orlando. I mean, Tampa, I've been downtown Tampa, St. Pete. What kind of apartment buildings are they building? It isn't affordable apartment complexes. It is luxury apartment complexes, which plays right into that. But hold on a second. What is really happening to those luxury apartment complexes that they built? Well, let's look at the vacancy rates. According to this data, the oversupply in the Sun Belts, let's just talk about Florida and Texas, vacancy in luxury units soared to 15%. 15%. And there are still 21,000 units under construction as of now. That's 6.5% of the total inventory. But hold on, let's just talk vacancies for a second. If we look at the total natural multifamily national vacancy rates, that was a mouthful. Let's just talk about the national multifamily vacancy rates. As of right now, the vacancy rates rose to 8%. Okay. And I don't have the data for where they were, but they're at 8%, and they rose to that. So as of late 2024, with 4 and 5 star luxury apartment complexes, that vacancy rate is 11%. So the national vacancy rate is 8, but the luxury vacancy rate is 11 and climbing. That's a 3% differential. Now, that may not seem like a lot to you, but if you're one of the luxury apartment complex owners, you are freaking out. Why do I know that? Well, come down here. Let's see. There are some major things going on. The landlords that own a lot of these luxury apartments, they didn't factor in 11% vacancy rates. They maybe did 3 to 5. Okay. So even by the national multifamily rates, the vacancies are 8%. Supply versus demand. People ignored the real demand. They ignored the fact that the real demand was affordable housing, but they didn't do affordable housing. And I can tell you exactly why. Because affordable housing isn't as profitable. Right here, I got the notes. Housing crisis is more complicated than it seems. It's more complicated than it seems. And this is Lazy Cash. Lazy Cash, got to move out of the way. We're doing a podcast here. He's our shop cat. So he joins us for some of these podcasts. But right here, the housing crisis is more complicated than it seems because developers are hesitant to build affordable housing because the profits are not as good and the margins are tight, which goes one step further. When they do the pro formas to get the bank financing, or they're doing the pro formas to put together a syndication or some money raise, if they show tight margins, how many of you want to invest in an affordable apartment complex with tight margins? Anyone? Jim? No? Brandon? Shauna? No? None of you want to do tight margins? You want the juicy margins, right? And I'm sure all of you are the same. You don't want to you don't want to invest your money in something that's super tight from a profit standpoint. You make money when it's profitable. So in comes luxury apartment complexes, mixed use apartment complexes with retail on the bottom. Oh, and by the way, retail vacancy, don't even get me started that's way up. How about office building vacancy? Off the charts. Yeah. Okay. Back to multifamily. So if 11% is the 4 and 5-star units, they're at 11% vacancy rate. Okay. And regular apartments or national multifamily is at 8%. Remember, I went back and I told you, hold on, where was it? That in the Sun Belts, the vacancy rate for luxury units was 15%. Are you picking up what I'm putting down? Yeah, we got some problems here. So in order to make the demand meet the supply, because we do have an oversupply, especially in Sunbelts, what has to happen? Let me ask all of you, put it in the comments right now. In order for demand to meet supply, what must happen? Price must come down on the luxury apartments to meet the demand. And this is what's happening. Landlords right now are panicking. They're offering 2 months of free rent, which is like reducing the cost by up to 25% if you did the math on that. So reducing the cost up to 25% just to get the demand to rent the supply because they can't make it at a 15% vacancy rate. And just so you all know, we're at the early stages of this cycle. As the economy weakens, I mean, just recently, I might get this number wrong, but just recently, I had read an article that UPS was laying off like 25,000 people. Folks, that's a leading indicator. If shipping isn't, if shipping and logistics is slowing down, what does that tell you? It tells you the whole economy is slowing down, leading indicator. So those shipping companies are starting to lay people off. You're hearing about some layoffs, not a lot. And the data is mixed, but the economy, make no two ways about it, is softening. As people lose jobs, as people get laid off, they're looking even more for affordable housing. But when there's 500,000 luxury apartment buildings being built and only 6,700 are affordable apartments. Sorry, I said that wrong. 6,700 are affordable. That's how many new construction affordable apartments are being built versus 500,000 luxury. You can see we got this sucker backwards. And the developers got it wrong. And that is the real housing crisis. But let's go back to what fueled all this and how did they get it so wrong? Well, go back to the pandemic. During the pandemic, we were all pent up. Okay. People were saving money. For one of the savings rate went up. One of the first times in a long time that savings rates went up. But not only did savings rates go up during the pandemic, debt was going down. Well, that was then. And then the world opened back up and the masks came off and we could fly around and we could go places without being badgered, without having a mask or being vaxxed or unvaxxed. I'm not even going to get into that. But when it all opened back up, what did people do? Well, it was the revenge summer. Just like right before the Great Depression, it was the revenge summer. People went out and spent and traveled, and Airbnbs were the thing to own because everybody was renting them because they just wanted to get out. They had spent all these years cooped up in their house. They couldn't go anywhere. The world opens back up. They're out there doing things. And people had money because they were saving and they were paying down debt. And after the pandemic, there was a massive job shortage. People didn't want to work. People didn't want to come back to work. So companies had to pay more. I know this firsthand. Like the amount we had to pay somebody to get them to do the same job pre-pandemic was a lot more. So people were demanding higher wages. And once wages go up, do they come back down? No, not until there's some type of severe economic slowdown or recession. And there's a pullback and people get laid off. And then people are like, well, all right, I guess I can make this much instead of that. I think I'm worth this, but I'll accept that because I need a job. So you see, all this stuff comes full circle. But during the pandemic or after the pandemic, the whole rage was there was a housing shortage. But for some reason, they failed to look at the data as to what the demand was because it was skewed because of the times. Massive money printing, massive stimulus, companies getting PPP loans and EDIL loans, and there was just money flowing. Wall Street had lots of money. The central banking system, the Fed, was pumping money. The government was pumping money into the system. Our deficit was skyrocketing. Yeah. Well, that fuel frenzy is what we'll call it, post-pandemic, resulted in bidding wars. Everybody wanted apartment buildings, so they were paying whatever it took. There was 1035 exchanges bumping prices up. You had companies like BlackRock and Blackstone going out there and buying up all the single-family homes, and they still are doing that. So pretty soon, we're going to be renting from who? Not mom and pa. We're going to be renting from the institutions because they're buying up all the inventory. They jack the prices up. And now with the median home price, now we're getting away from multifamily and going to the median home price being over $158,000, less than 25% of the US population can afford a new home. Those are the numbers. But back to multifamily, when this all happened, when there was this massive frenzy, not only was that frenzy bid up by institutions buying single family and apartment complexes and people out there just trying to buy investments because they were just looking to get ahead and they had some money that they saved up, so the prices soared and rates. Oh yeah, let's not forget where interest rates were at that present time. But let me just show you something here. I'm going to share my screen here real quick, and I just want to show you some of the data here. Why developers keep building luxury while affording housing lags? Well, here's the numbers, and I'll explain exactly that. Why developers keep building luxury while affording affordable housing, which is the real need, lags. Well, right here, by the numbers, you can see the national multifamily vacancy rate rose to 8% late 2024, with 4 and 5-star units at 11.4%. So significantly higher. And look at this right here. You can look at the years. You can see here after the Great Recession, there we go. 4 or 5 stars went down. Why? Because people couldn't afford them. Duh. Affordable housing really never really bumped up. And look at this. You can barely even see the 1 to 2 star. It's like way down here. But you can see, look at this spread. Look at that. Here's 4 to 5. This chart right here, okay, the light blue is the 4 to 5 star, the luxury apartments. And then down here, yep, those are the 3-star. We'll call that affordable housing. You see the problem? You see the problem? Yeah, there's a problem, all right. Not only that, the other problem that we got to really address is this. The average interest rate right here, the average interest rate on commercial real estate loans the last 30 days, okay, office buildings are 6.6. That's lower than they were. You got 5.4 on retail, 5.8 on industrial, multifamily 6.3. Well, folks, that is what they call expensive money, especially when you compare it to pandemic and post-pandemic. That's right. And there's another thing, and I've talked about this a lot. There are, if you look at the CRE loans, okay, commercial real estate loans, the loans that were written when this whole thing was going on and developers were building all this because there was a huge need, so there was a huge demand for apartment buildings, for housing. Remember, all you ever heard was there was a massive demand for housing. There was a huge housing shortage. Nobody ever said, well, there's a huge affordable housing shortage. A couple of people maybe did, but not many. Most were just saying there's a huge housing shortage. But when in reality, there was a huge affordable housing shortage. But the developers took advantage of all that easy money, because that's what it was, easy money post-pandemic. With the low interest rates, they locked in their CRE loans, their commercial real estate loans, for 5, 7, or 10 years, because that's what they all are, 5, 7, or 10-year rate locks. Then you got to refinance. You got to, those loans mature. So hold on. Let me get this straight. If I started the process to build a big multifamily luxury apartment complex, how many years do you think that takes to go through all the planning, get the financing, raise the money, get it all approved through the town, get the permits, get the construction going? Easily 3 years minimum, some longer. So 3 to 4 years. So here we are, we're 2025. Let's go back 2024, 2023, 2022, and let's go to 2021. Are you seeing what I'm seeing? All the housing starts had to have started during the glory days, the hoo-hoo days, the la-la days is what I like to call them, when things weren't real. Interest rates were not real. They were historically low because they were trying to stimulate the economy after shutting it off. Literally, I didn't say shutting it down. I said shut it off because they did. They shut the world down during the pandemic. So then they flipped the switch back on, printed a whole bunch of money, dropped interest rates to close to zero, made money really easy for these CRE loans. Everybody went out. These developers went out and started building. And here we are. They're now just finishing some of these projects. A lot of the projects, as I showed you, 500,000 are still under construction. All of these luxury apartment complexes are being completed in a time when people don't want luxury apartment complexes. They want affordable housing. That's what they need. That's what the demand is. But these developers started the process when the demand seemed to be luxury because it was the la-la land, the foo-foo land, the fake reality. And now we're waking up to that. And now we're seeing that the real housing crisis is one that is very complicated, very multidimensional, and it was all fueled by the post-pandemic frenzy. Prices were high, and where are they going to go in the future? Lower. Interest rates were low, and where are they going now? Higher. Maybe they'll go a little lower, but they're not going to do that in time because remember, CRE loans were 5, 7, and 10 years. Did we do the math? 2020 to 2025. That's 5 years. It just started. And I did a whole YouTube on this, giving all the stats that in 2025, this many CRE loans and commercial loans were going to mature, 2026, 2027. It's a real pandemic, if I might say, because when these all mature, guess what they're doing? They're maturing to the new interest rates. And the Fed doesn't seem to be in a hurry right now, contrary to what Trump is trying to do and get them to lower rate. They don't seem to want to lower the interest rates, do they? So here we are in an elevated interest rate market. Some would say, the smart ones would say, we're in a normal interest rate environment. But it's not normal when you've got a maturing CRE loan that you got at 3% during the glory days, and now it's going to mature at 6%. What does that do to your monthly payment? It jacks it up, right, Cashy? The monthly payment on these CRE loans are all going up substantially. What else is going up? Insurance has gone up tremendously since the pandemic. What else has gone up? Taxes, property taxes. Oh, yeah, I've seen property taxes go up around here. And I'm sure you're seeing the same thing. What else has gone up? The cost of everything, folks. The cost of everything went up. Interest rates drove them up, supply and demand drove them up, and now tariffs are driving them up. So if anything goes wrong in your apartment building, it costs more to fix it. And all your utilities and all your fixed costs to own these apartment buildings are all higher. So now all your costs are skyrocketing. And what is your rent, your income doing? I already told you. It's going down. Landlords are panicking, offering 2 months of free rent, reducing rents. They have to. Demand needs to meet supply. And the only way to do that is price needs to match the demand. This is problematic, folks, because all those really profitable pro forma luxury apartment complexes, well, I don't think they're going to be quite as profitable. And when some of these loans come to maturity and the bank starts asking for all the financials, well, it's going to be a different story, a different set of books that they're going to be looking at than they did when they issued the loan. This, my friends, is the real housing crisis. The real housing crisis that no one's talking about, that no one wants to talk about, that no one even wants to accept as the reality. But folks, it's real, it's happening, it's going to get worse, and you are going to be along for the ride. So you might as well get educated. You might as well see what's going on. Now, let me give you my little spiel. You might as well learn how to take back control of your money. I know for some, it's going to be too late. For the rest of you, let's learn how to take back control. Let's learn how to be our own bank. So we don't have to worry about all these issues, because when you're your own bank, you are in control. You make the rules, you set the rates, you set the terms. You are the bank. If you want to learn more, hit me up with a comment below, and wherever you're watching this podcast, throw this a like if this was helpful. If this scared the shit out of you, just say, oh shit, in the comments, because you know what? That's what we can do in this podcast. Folks, thank you for joining me for today's episode of The Real Housing Crisis Explained. We'll see you on the next episode. Until then, go out there, have fun, and take back control of your money. We'll see you next time.